Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at HP.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, we always appreciate the support from you guys.
We really do. And before we get into the thick of it, just a quick reminder for anyone wanting to seriously upgrade their market research, check out VIP Algos. The VIP Algos link is below in the description. You definitely want to take a look at that.
Absolutely, it's a fantastic tool.
So let's jump right in. I want to try a quick word association with you.
Oh boy. Okay.
I'm going to say the name of a company, and I just want you to notice the very first image that pops into your head. You ready?
I'm ready.
HP.
Honestly. Probably replacing a cyan ink cartridge in some giant beige office printer. Or maybe like the hum of one of those clunky desktop towers booting up.
Right, exactly. It screams 1990s legacy hardware. I mean, we have all been conditioned to view them as dependable, sure, but ultimately, well, pretty boring.
Yeah, they're basically part of the office furniture at this point.
You certainly don't associate them with aggressive innovation or anything flashy.
Definitely not. I mean, they are generally not the first name on anyone's list when you're discussing, explosive growth or Wall Street darlings.
Right.
The traditional perception is very binary. They make physical boxes, they ship them out, and that is pretty much the extent of the business model.
But see, the data we are looking at today tells a completely different story. Today, we are synthesizing a massive stack of recent quarterly earnings reports, SEC filings, technical market analysis, all to figure out why this boring hardware giant recently saw its stock violently surge 10.4%.
Yeah, on a single piece of news, no less.
Exactly. And if you pull the lens back just a bit, the stock is actually up over 32% in just the last 90 days.
Which is, that's the kind of rapid, violent repricing you would expect to see from some lean Silicon Valley software startup.
Totally.
Not a decades-old manufacturer of physical hardware. A move like that really signals a fundamental reassessment of what the company actually does.
And that is exactly our mission for this talk.
Right.
We need to look past the surface-level price action and really dig into the underlying mechanics.
Mm-hmm.
We're going to explore how HP, which trades under the ticker HPQ, by the way, is attempting this incredibly aggressive pivot. They are trying to go from a standard hardware vendor into a highly sticky AI-integrated solutions provider.
It's fascinating.
It really is. And, if you are managing your own portfolio, this is essentially a masterclass in how legacy companies attempt to reinvent themselves.
Yeah, because it is so easy to get swept up in the flashy hype of pure-play AI startups right now.
For sure. Everyone's looking for the next big thing.
Right. But the real structural shifts in the market they often happen when massive legacy companies finally figure out how to leverage their existing footprint.
Yeah.
And understanding the actual financial mechanics behind that transition, things like free cash flow, PE ratios, installed user bases, that is how you spot true fundamental value before the broader market catches on.
So let's start with that existing footprint. Because a stock price doesn't just jump 10% in a single trading session entirely on a promise.
No, definitely not.
There has to be a foundation.
Yeah.
So before we even touch on the AI narrative, what is the core business reality that's driving this momentum?
Well, the foundation here is really the sheer overwhelming scale of their global installed base. It is massive. They have millions of personal computers and enterprise printers just deeply embedded in corporate IT departments all over the world.
Right.
And that installed base, that is their primary competitive moat.
I want to break down what that moat actually looks like in practice for our listeners. Because in the corporate world, an IT department doesn't just wake up on a Tuesday and decide, hey, let's rip out 10,000 machines and switch to a different brand to save a few dollars.
Oh, never. It's a logistical nightmare.
Exactly. The logistics of migrating thousands of employees to new hardware, dealing with software compatibility issues, retraining staff, it creates massive switching costs.
Yeah, that inertia is a huge asset for them. It provides this completely captive audience. But, what caused the recent surge wasn't just maintaining that audience.
Right. Something changed.
Right. It was the announcement of a new global partnership with OpenAI. HP is integrating OpenAI's frontier platform directly into its devices, right alongside its proprietary workforce experience platform.
Now, this is where I need to push back just a bit, because literally every tech company right now is announcing some kind of AI partnership.
They really are. It's the flavor of the month.
So is slapping an OpenAI logo onto a laptop Really enough to permanently widen their competitive moat against rivals like, say, Dell or Lenovo? I mean, surely Dell and Lenovo have the exact same access to AI models.
Well, if it were just a chatbot window pre-installed on the desktop, you would be absolutely right to be skeptical.
Okay.
Because, yeah, Dell and Lenovo could copy that by tomorrow afternoon. But that isn't what HP is doing here.
Okay, so what makes it different?
The differentiation really lies in how the AI integrates with that workforce experience platform you mentioned.
Break that down for us. What is that platform actually doing behind the scenes?
It basically acts as a telemetry and management layer. HP is integrating proprietary AI software agents that actively monitor device health. They analyze how employees are interacting with their local data, and they optimize enterprise workflows securely on the machine itself.
Ah, got it.
This is what the industry refers to as edge AI, meaning the processing happens locally on the hardware rather than sending highly sensitive corporate data back and forth to some public cloud.
Wow, okay. That actually reminds me a lot of the evolution of smartphones.
How so?
Well, think about when you bought a basic flip phone years ago. You bought it purely for the physical hardware to make phone calls?
Right, there was no other use for it.
Exactly. But once Apple and Google integrated app stores and these cohesive software ecosystems, the physical hardware actually became secondary to the software experience.
Well, that's a great point.
You became locked into the ecosystem because all your data, all your habits were there. The phone became, well, sticky.
That is a very apt comparison because HP is trying to turn the basic commoditized Office PC into a localized, highly secure AI ecosystem. If an enterprise customer spends 2 years letting HP's local AI models learn their specific internal workflows and optimize their data securely, well, switching to Lenovo suddenly isn't just a hardware migration headache anymore.
Right, because you'd be losing all that customized machine learning.
Exactly. You literally lose the organizational intelligence you've built up.
Okay, so the strategic pivot makes total sense. But transitions like this are notoriously expensive.
Don't vary.
Building out proprietary AI management software takes immense capital. Let's look at the underlying numbers from the financials. How are they paying for this without completely destroying their balance sheet?
So this is where the legacy aspect actually works in their favor. Over the trailing 12 months, they achieved revenue growth of 5.74% year over year.
Wait, really? Because in a macroeconomic climate where corporate IT budgets have been incredibly tight, pulling off nearly 6% top-line growth in hardware is super significant.
It is. But more importantly, let's look at the margins. They're currently maintaining a gross margin of 20.31% and a net margin of 4.45%.
Wow.
Yeah, bringing in a trailing 12-month earnings per share of $2.71.
You know, think about what a 20% gross margin actually means for a legacy hardware company right now. Most hardware vendors are in this relentless race to the bottom on price just to maintain market share.
Exactly. It's a brutal industry.
But they are holding a 20% gross margin while actively funding an aggressive pivot into edge AI. It really shows their core, boring business is robust enough to subsidize all that research and development.
Yeah, and they are running massive operational efficiency programs alongside this. So they aren't just bleeding cash to chase an AI narrative.
Right.
They are a profitable, cash-generating engine that is attempting a major software-driven upgrade.
All right, I understand the narrative and the margins look good, but now we really have to talk about what the market is charging investors to participate in this story.
The valuation.
Yes, because this is where the data gets genuinely shocking to me. Usually, anything with the letters A and I in its press release is priced at a massive premium.
Oh yeah, the multiples are usually insane.
But according to the financial data we pulled, this stock is currently trading at a trailing PE ratio of just 8.67.
Yeah, a multiple under 9 for any company with a viable tech growth catalyst is remarkably low.
And the price-to-book ratio is currently sitting at 0.79. I want to pause on that metric for a second because it highlights a massive disconnect.
It really does.
A price-to-book ratio under 1 basically means the market is valuing the company at less than the sum of its literal physical assets. The market is effectively saying that HP, as a going concern, is worth less than if you just liquidated its real estate, its patents, and its inventory today.
Which points to a market that is aggressively undervaluing the company's asset base.
Yeah.
I mean, they are completely ignoring the new AI growth vector they are actively building.
I hear you, but let me play devil's advocate here for a moment.
Sure.
Usually, if a tech company has a PE under 9 It means the market thinks that companies' best days are squarely in the rearview mirror.
Right, the classic value trap.
Exactly. It's the textbook definition of a value trap. You buy the stock because the metrics look cheap, but it's cheap because the core business is slowly dying. So how do we know this isn't just a classic value trap wearing a flashy OpenAI mask to distract investors?
Well, it is the single most important question to ask when you encounter a valuation this low.
Yeah.
The dividing line between a dangerous value trap and a true deep value opportunity almost always comes down to free cash flow and capital allocation.
Okay, so how are they using their cash?
Right. How is management using the cash they generate? In this case, they generate robust free cash flow, and they aggressively return it to shareholders. They currently maintain a heavily covered 5% dividend yield.
But, a dividend is only safe until management decides to cut it to fund their expensive AI ambitions.
That's true.
Is there any evidence in the financials that a 5% yield is actually sustainable during a major technological transition like this?
The payout ratio actually tells us it is sustainable. They're not borrowing money to pay that dividend. It is comfortably covered by their operating cash flow.
Okay, that's reassuring.
And they are coupling that dividend with consistent share buybacks. When a company repurchases its own stock while paying a high dividend, it provides what we call a hard floor for the equity.
Walk us through the mechanics of that hard floor. How does a dividend actually stop a stock price from falling?
Think of it mathematically. If the stock price drops, that 5% dividend yield actually goes up relative to the lower share price.
Right, the yield percentage increases.
Exactly. Let's say it hits 6% or 7%. At a certain point, value-oriented institutional investors like pension funds and large mutual funds, they will step in and purchase the stock simply to capture that massive, relatively safe yield.
Oh, I see. So that institutional demand creates a safety net.
Yes.
The stock falls, the yield becomes too attractive for income funds to ignore, they start acquiring shares, and the price stabilizes.
Exactly. You are essentially getting paid a 5% annual yield to just wait and see if the OpenAI partnership successfully transforms the business. You get downside protection while the growth thesis plays out.
Okay, so if the balance sheet provides a safety net and the valuation is historically cheap, the next logical step in our analysis is to follow the money.
Always follow the money.
We need to look at whether the people closest to the actual business operations believe in this turnaround. And I am looking at the insider transactions over the last 90 days, and the signal here is deafening.
The insider activity paints a very clear picture of internal sentiment. We are seeing massive insider cluster buying.
Yeah, the filings show that insiders acquired 141,676 shares across 14 separate purchase transactions over a 3-month window. And during that exact same period, there was only one single sell transaction.
Which is wild. Because when you look at insider activity, a single executive buying shares could just be, personal portfolio balancing.
Sure.
But cluster buying, where multiple executives and board members are aggressively acquiring shares with their own money in a short window, that is one of the strongest votes of confidence you can find in the market.
Wow.
It indicates that management collectively believes the current stock price severely undervalues the forward earnings trajectory they see internally.
And the market is clearly starting to wake up to that internal confidence. Let's examine the recent price momentum. The stock has posted a 28.21% return over the last 13 weeks. If you measure over the full 90-day window, it is a 32.64% return. That upward move completely outpaces its one-year total return, which was essentially flat before this.
A price chart like that tells us this is a fresh, narrative-driven breakout. The market is digesting the OpenAI integration and rapidly repricing the company.
But the technical setup offers a really interesting wrinkle here. The stock is currently trading around $24.22.
Right.
It has been carving out a very clear pattern of higher highs and higher lows since it bottomed out back in February 2026 at $17.56. Yet, despite this massive 32% run, it is still 18.3% below its 52-week high of $29.65, which it hit back in June.
Yeah, and the most fascinating element of this technical setup is actually the trading volume behind the recent rally.
What's going on with the volume?
Well, the market reports indicate that current volume is running at just 0.75 times its 3-month average.
Wait, let's unpack that. Doesn't a strong, legitimate rally usually require high trading volume to sustain itself?
Usually, yes.
So if volume is below average, doesn't that imply a lack of conviction from the buyers?
Not necessarily. In this specific context, low volume during a steady climb indicates a severe lack of selling pressure.
Oh, interesting.
Yeah, the people holding the stock, whether it's those institutional funds collecting the dividend or the insiders who just acquired 140,000 shares, they're refusing to sell, even as the price appreciates.
I see where this is going. The data also notes that the stock has a high beta of 1.24, making it notably more volatile than the broader market. And there is a speculative rumor circulating among technical analysts about a potential short squeeze dynamic setting up. Let's tie this all together. If you have low volume and insider hoarding, how does that actually trigger a short squeeze?
So think of the available shares on the open market as oxygen in a room. Insiders just absorbed over 140,000 shares and locked them away. Value funds are holding tightly onto their shares to collect that 5% dividend.
Ooh.
So the oxygen, the actual available supply of shares to trade, is incredibly low.
So if there are institutional short sellers out there who bet against this boring hardware company months ago, they are currently sitting on losing positions as the price climbs.
Exactly.
If the company releases a phenomenal earnings report and those short sellers suddenly panic and need to purchase shares to cover their bets, there is almost no available supply for them to get.
That is the exact mechanism of a short squeeze. That sudden, desperate demand hitting a market with highly restricted supply is what causes a stock price to violently gap upward.
Wow.
When you combine that lack of supply with the stock's naturally high beta, any forced buying could absolutely serve as rocket fuel to launch the price back toward that $29.65 previous high.
It is a really compelling setup, but we cannot just look at the upside.
No, you have to look at the whole picture.
We have to flip the coin and look at the risks. With a historically cheap valuation, extreme insider confidence, and a potentially explosive technical setup, what could go wrong? What could completely derail this momentum over the next 6 months?
Rigorous risk assessment is vital here because the narrative has already done the heavy lifting. Now, execution is everything.
Let's start with the primary bear case highlighted in the data, which revolves around severe supply chain constraints.
Yeah, that's a big one.
Global PC shipments actually saw a notable decline in Q2, and the primary culprit was widespread memory chip shortages.
Right.
I have to issue a direct challenge to the bullish thesis here. If they cannot physically secure the memory chips required to manufacture these new high-powered AI PCs, then having proprietary OpenAI software integrated into your platform is entirely irrelevant.
That is a harsh reality, but it is 100% correct. The semiconductor supply chain is a very real physical bottleneck. You can design the most elegant edge AI integration on the market, but if you cannot assemble and ship the physical boxes to your enterprise clients, you cannot recognize the revenue.
Right?
If they fail to meet the heightened demand generated by this AI hype cycle due to component shortages, the market will punish them severely.
Which feeds directly into the second major risk factor valuation compression. Some analysts are looking at this recent 32% price surge and arguing that the stock is now fully valued based solely on the OpenAI announcement and one recent earnings beat.
Well, the market has effectively granted them a grace period.
Okay.
The stock's multiple has expanded because investors are willing to pay for the potential of this AI transition. But if they fail to execute on the roadmap, if those AI PCs don't roll off the assembly line fast enough, that multiple could contract sharply.
Sending the valuation right back to those depressed historical hardware averages.
Exactly.
So if the clock is ticking on this grace period, at what point do investors demand to see actual physical proof that this strategy is working? Let's consult the catalyst calendar for the next 3 months.
The ultimate proving ground will be their upcoming quarterly earnings report.
What are people looking for?
The entire financial sector will be hyper-focused on one specific metric: early AI PC attach rates. Are enterprise IT departments actually signing purchase orders for these new, expensive OpenAI integrated machines, or are they just refreshing their fleets with cheaper legacy hardware?
So they have to prove they can monetize this partnership beyond just a press release.
Right.
But zooming out to the broader macroeconomic picture, the data highlights another potential massive catalyst arriving in late 2026. The Federal Reserve is widely anticipated to begin cutting interest rates. How does a macro event like a rate cut specifically impact a company selling enterprise laptops?
It comes down to the cost of corporate borrowing. Enterprise IT departments rarely purchase hardware outright. They lease it or finance it. When interest rates are high, the cost of financing a massive fleet upgrade is prohibitive. So companies force their employees to hold on to older machines longer.
So they stretch a 3-year hardware life cycle into a 4 or 5-year life cycle just to save cash.
Precisely. But if the Federal Reserve cuts rates, the cost of capital drops. That makes leasing new equipment significantly cheaper.
Got it.
We could see a massive, pent-up enterprise IT hardware refresh cycle trigger just as they're rolling out these new AI-capable machines. A declining interest rate environment colliding with a major new product cycle is the absolute perfect storm for a legacy hardware vendor.
Wow. So bringing all of this data together, the valuation metrics, the AI integration, the insider transactions, and the macro catalysts, what is the final verdict on the outlook here?
Synthesizing the analysis today, this stock earns a robust 8 out of 10 bullish score. It is positioned as a highly attractive opportunity for the medium term, particularly for those looking at a 3 to 6 month time horizon.
It really is a genuinely rare profile in today's tech market. You have deep fundamental value anchored by a 5% dividend and aggressive share buybacks, which provides a solid safety net. And layered on top of that, you have a newly ignited growth engine via the OpenAI integration.
Yet the technical momentum and lack of supply give it a strong case for a breakout toward that $29.65 level, while the cash flow protects you if the supply chain gets rocky.
And, if you are ever in doubt about the internal trajectory, just look at the insiders who poured their own capital into 140,000 shares over the last 90 days. They clearly know something about the forward guidance that the broader market is only just beginning to price in.
Oh, absolutely.
So if you are managing your own investments, the biggest takeaway from today's show is a lesson in cognitive bias. The most lucrative market opportunities rarely look like flashy, highly publicized new startups trading at astronomical multiples. They often look like legacy giants companies you completely dismissed as boring office furniture undergoing quiet structural reinventions. While the crowd is fighting over the most expensive software stocks, true value is often found in the companies building the physical, localized infrastructure those AI models require to function in the real world.
It is entirely about looking where the broader market's attention isn't, and recognizing when a company is leveraging a massive existing footprint in a completely new way.
Beautifully said. So I want to leave you with a final, lingering thought to explore on your own.
Let's hear it.
If a legacy hardware company, a brand most famous for beige printers and toner cartridges, can completely revitalize its market narrative and ignite a 32% stock surge with a single strategic AI integration, what other dinosaur tech companies are out there right now hiding in plain sight? Who else is sitting on a massive, untapped global installed base, generating boring but reliable cash flow, just waiting for an AI spark to bring them back to life?
The folks who answer that question first are the ones who capture the most upside.
That is the puzzle we love trying to solve. Remember, if you want to dive deeper into setups exactly like this, the VIP Algos link is below in the description. Be sure to check it out.
Highly recommend it.
And as always, if you found today's breakdown valuable, please subscribe, like, and leave a comment below. Until next time, keep digging into the data.